Welcome to the Treasury Update podcast, presented by Strategic Treasurer, your source for interesting Treasury news, analysis, and insights in your car, at the gym, or wherever you decide to tune in.
Welcome back to the Learning from Financial Fraud series on the Treasury Update podcast. In this series, we explore multiple major financial fraud cases. We discuss how each one occurred and was kept hidden for a period of time, and we'll dissect how it was eventually discovered and get insight and guidance on how to prevent this type of situation from happening to you and your organization. I'm Jonathan, Media Production Specialist here at Strategic Treasurer, and your host for this podcast, and I'm here with Craig Jeffrey, Managing Partner. Welcome, Craig.
I'm glad to be back here. I'm surprised at how many accounting, financial frauds there are. I think this series could go on almost forever, so there you go.
Well, that is the plan. We're going to keep doing this forever. And when we get to episode 50, you'll have to recap all 50. So with that, the first 5 cases we looked at in this series were covering Parmalat, Satyam, Wirecard, FTX, and Enron. Can you give a quick recap of what happened in each of those episodes for the listeners who haven't heard about them?
Sure, I'll try to be quick. Parmalat was an Italian dairy. Billions were lost. There were fictitious accounts. They fooled auditors by sending documents. That was a little over 20 years ago. Satyam was an Indian technology firm. They exfiltrated over $1 billion. They used internal collusion and fictitious employee accounts. There was a confession by one of the owners, which triggered the collapse of that in the jail cases. Wirecard was brought about by lack of visibility, this idea of kiting funds moving around between different entities. It was a huge payment company. The loss was massive. FTX trading. FTX is think of a cryptocurrency, digital currency. They named stadiums. They made all kinds of political donations. They used customer funds for personal use and trade. Massive losses. The name Bankman-Fried is a key player there. And number 5, the Enron accounting scandal. This was the illegal use or inappropriate use of special purpose entities where they would move losses out of the main Enron entity into the other special purpose entities and created trades that were not actual trades but were more loans. This also brought about the downfall of the Arthur Andersen name. There we go.
Nice. So if any of those sound interesting to you guys, all of them will be linked in the description. So feel free to listen to those afterwards. But today we are taking a look at the $65 billion Ponzi scheme that was run by Bernie Madoff. Craig, what's the deal with Bernie?
Bernie has now met his maker. He died when he was 82, so he's no longer around. But the deal with Bernie is he ran this massive Ponzi scheme. Maybe that's a Freudian slip. Certainly those 40,000 people who lost money screamed about that. But he brought it up to $65 billion. Certainly multiple billions were recovered, but a huge fraud. Spent it on cars, mansions, all kinds of lavish gifts. And it was centered on a number of things. This keeping things hidden. There's a lack of visibility to trades and the trading schemes. And he covered that up with an accounting firm, a firm that was doing the auditing, that he essentially had a type of control over. And so the checkers weren't valid. The ones that were checking the books weren't, nobody was checking on them. And there was a bunch of early warnings and repeated warnings, people saying it's impossible to get these kinds of yields, and they were ignored for a long period of time. And this has really taken advantage of people's desire for extremely outsized rewards, consistent outsized yields year over year over year. No losses, but consistently beating the market, which I think we all know is too good to be true.
So he probably started out with wanting to be one of those people that wanted to consistently beat the market, and he realized he could leverage that.
Yeah, it's hard to say what goes on in someone's mind for doing well. He was certainly a smart person. He leveraged his former positions of prestige and governing markets to do this activity. And then I guess once it starts failing, there's a problem. How do you cover it up? And then it just rolls and snowballs. I imagine that's part of the challenge that goes on. But he got a 150-year prison sentence. So he still owes some years.
So how exactly was he beating the market for these people? What exactly was he doing?
Well, he wasn't beating the market. So the question is, how was he beating the market? He was providing statements that appeared to be beating the market. And so you would get statements that showed you had made significant returns. So, hey, I'm doing well. Let's pour more money into that. And it was consistently beating it. So he was creating statements that showed them beating the market. And when people had to do withdrawals, because he was spending huge sums over time, he would pay, if someone ever did a withdrawal for, 50 million or 100 million, he would use all the new money that was coming in, additional people, which is why it's called a Ponzi scheme, to pay them out. So he was just providing a statement. It's like I created a statement and did it in Adobe and sent you the file and say, here's your statement. You've got 100 million, but I spent 90 million of it. How do you know from the statement? You're relying on, hey, these books are checked. They're validated. The accounting firm's looking at them, got a good, clean audit report, but it wasn't clean. They didn't have the assets.
So he had already spent the money that was said it was invested, used new money to pay for whenever someone had a withdrawal or interest or whatever.
Yeah, and he's pretty good. I mean, think about how many people you could convince to give that much money, and you're spending a ton, and you're trying to get more assets to come in to cover that. And you ran it up to 65 billion. I mean, that's pretty big league stuff.
Yeah, it sounds like he wasn't able to recover most of it. So what were the losses for the victims of the scheme? How were the victims compensated at the end?
Victims received some money back. A number of them did. And I pulled some information about how many losses there were. We knew there was over 40,000 people who were impacted. And there were a number of feeder funds. So there'd be investment companies that were taking funds in, and they would feed into the Madoff fund. And, so there's this amplification. It was like there's a Ponzi scheme, but there's also a distribution element to it, that these firms thought this was a great investment. They had gotten in with the Madoff funds and would take funds from their customers and feed them over to here. And that became a significant problem. So in terms of the size, Jonathan, as you look at that, it's the top 10 investors who lost in terms of their exposure, at least in the beginning. The top 10 all had $1 billion or more in the funds, and the next 6
weren't recovered.
Well, I don't think we have data on how much was the initial exposure and how much was recovered. We know that there was 18 billion of the 65 billion recovered. Maybe there's more than that. I don't know that there's an exact accounting, for the 40,000 people, what they had in there, what was recovered, how much of that 65 billion was inflated yields. So if you put in 100 million, it became 112 million, 128 million. How much of that was inflated yields and how much of that was actual money that came in? I don't know that there's a full accounting of that because the record keeping was so poor. But in terms of what people had and their potential exposure, these are some of the numbers that you see. Yeah, so 10 were over $1 billion. Another 6 were $500 million to $1 billion. Another 11 were $250 million to $500 million. So just there, that's 27 entities, a couple individuals who had huge sums of money invested there that lost it. It's been reported at least 18 billion was recovered. So how much was principal that was lost? How much was inflated earnings that were lost? How much was lost opportunity? Those are really hard to say.
Yeah. Okay. So we don't have all the information on that, but we know that not everybody got their money back.
No, I don't know that anybody got all of their money back. I think the ones that got back got a settlement for some.
How did he keep this deceit going on for so long?
Yeah, there's a lot of movies about that. It's hard to say, especially when there's warnings and you go back and you say, hey, there were all the signs. Why wasn't that found sooner? He was a former chairman of NASDAQ. So he had good street cred, good credentials. So he had the chops for it. He had consistent high returns, and people were trying to get in. Once people were trying to get in, it was this idea of, hey, everything's exclusive. Like if you want to get in the Madoff funds, you got to be an exclusive person or fund that's very restrictive. So people would be, asking, and funds were asking and heavily, I don't know about begging, but really working to get into the fund. And so there was this whole process of he was able to get people to fall into this track. And then as he had a supposed or an alleged track record of above average returns, that became, here's a paper trail. Here's the trajectory for a long period of time. And so he was able to keep it going as long as he could take more funds and redeem and support the redemptions that people were asking for, that charities were asking for, that banks were asking for, that individuals were asking for. It held up. They're looking at their statements. It looked good.
So when you see things now that are offered that offer higher percentage than you're going to get in the market, what concerns should you have? And like, let's say your average market return is going to be,
well, let's say it's, on the equity side, perhaps you're looking at 8.5 to 10.5 over time, sometimes 11. You might be looking at that over the course of a long period of time. Bonds will look different, and, short-term cash instruments, may look different as well.
So if someone comes out with something new that's offering 10% more than that, how do you verify that? How do you verify that what they're doing is legit?
Well, there's the efficient frontier. You think about investments. If everything's efficient, the higher risk you take should relate to a higher return. But higher risk will, there'll be a reversion to the mean. And so if you're taking something that's very risky, you should have significantly higher returns, and that may bode well for you for a period of time. Or it may be, disastrous as you lose very significant sums of money. So anything that might be favorable for particular market conditions is something you want to understand what's being invested, how it's being tracked. But when someone says, "Oh, we're going to do 5% better or 8% better than the market, than other active or passive fund management firms," like, how is that going to be possible that someone's that far ahead for that long? And it has to be viewed as, that's exceptional. How is that going to work? Are they in a unique position? They're the only ones who can do it. Do they have a monopoly somewhere? Like, that would be investing in a company. But how many of those monopolies exist? That becomes very challenging to think you're going to be that much above the market without a downside, right? So more risk means you're going to have some volatility, and not having volatility is, that can be somewhat of a question. If you're getting outsized returns, there should be more risk.
Yeah. So be skeptical and just weigh the risk.
Yeah.
How do you move into that?
Well, it is. That's kind of like being from Missouri, the show me state. There should be some skepticism. You should understand what you're investing in, of course, right? All the professional investment advisors say you should understand what you're investing in to some extent. Don't, especially if you're looking for outsized returns. If you're looking for outsized returns, you're going to concentrate that into fewer companies, not necessarily be in this massive fund. And certainly some funds can do better for a time, but once they get to a certain size, they're finding investments that are more preferable, or whatever the advantage they have. Then they have too much money and it gets diluted. They have to go downstream and earn less.
Gotcha. So what were the punishments?
Well, the punishments, his sons, Andy and Mark, turned him in. So punishments were, I guess, uncomfortable family dinners, whether they were at home or in prison. He got 150 years in prison. That was the assignment, which I don't know that we have a lot of people living. I can't remember how old he was when he was convicted. I think he was in his 60s. You're not going to be living to be 200 years old, but he died in prison at the age of 82. So those are some of the consequences for him.
Yeah, I don't know the difference between a life sentence and 150 years in prison, but they sound kind of similar to me. What were the regulatory oversights that allowed the SEC and other regulatory bodies to fail in figuring out this Ponzi scheme?
Well, some of the misses, SEC and others have an oversight responsibility, and so missing on those is significant. They received a number of warnings over the years, over multiple years. They'd receive warnings from people like, this can't be the case. Some people have written, it's like, I've run models. Even if I'm selecting certain types of instruments based on what Madoff says, I can't get to those yields. It's not possible to do that. Even if you look back in time and say, I'm going to pick the best options, right? I'm going to go and pick from these categories whatever the best choices would be. Like, it's not possible to hit those types of returns. And so they investigated him at different times since 1992, and they always came away with it was fine. From 1992 to 2000, Harry Markopoulos filed a formal complaint with SEC. Some of the different agencies that overlooked these didn't necessarily coordinate as well as they should. But by 2005, the SEC looked for additional documentation on the trading accounts, and Madoff did what? They weren't accurate. So what he did, he created a fabricated list, and the SEC looked through it and said, hey, this works. They didn't actually verify that those were trades held in accounts. So here's the support, but it's fictitious. So he provided a good paper trail, but there was no actual action from that.
A step up from creative accounting.
Yeah, this is quite great. Like, I papered it over. Like, here's my documentation for everything that worked. And there shouldn't be a trust but verify in a validation process. It should be, hey, I'm looking at it. I'm going to validate things. If I have questions, I'll check on it. But this was at a massive level.
So what kind of things can Treasury, can finance learn from this? What kind of things should we be looking out for in the future?
That's a good question. You know, when you had said, let's cover the Madoff investment scandal, my initial reaction the one in my head was, why are we covering that? I mean, it was charities and individual investors that got ripped off. What does that have to do with Treasury and finance? But then I thought about it a little bit more. I was like, wait a second, there's an organization here, the Madoff Investment Organization, and how it's regulated, that there's a lot of learning that can take place outside of that. And so I realized, hey, this is a good environment and a good thing to talk about for Treasury and finance in general. I guess a couple things. When we talked about what went on, this ability to hide things. You know, how do you hide things? You want to make sure there's no visibility. You want to restrict it to a certain few people. And, the idea and the security principle of least privilege, the principle of least privilege, I know it's the idea that people and IDs can only have access to the data and the functions that they need access to, because otherwise it's, if someone gains control of an ID, they can do too much damage. People should only have access to information they need, or it can get out. You can have significant damage. It's a way of protecting people, protecting the organization, protecting your clients. But that doesn't mean super secrecy and creating this, complete opaqueness. And how, what are some of the ways that we get around using that principle of least privilege to a detriment is making sure that there's fresh eyes put on processes, cycling your auditors through. The new auditors come through, they haven't heard the same story 4 years in a row, and they're too embarrassed to go back and ask a question that they passed 4 years in a row. Same thing with staff. I mean, it used to be everyone was required at banks, for example. They had to take 2 weeks of vacation off in a row. Why was that the case? Well, it made someone else had to do the work long enough so that a number of the functions would be done. If someone's gone for a week, they can usually let it sit, and then the person can cover up, if they're misappropriating funds, moving funds out, or cooking the books, as it were. It allows them to adjust that. So that idea of rotating your staff, getting fresh eyes on the process, and this can be, you can have an external auditor look at things. You can have someone review or assess a process. In your rotation of staff, one thing that can also happen is having someone externally come in and run a function for a period of time, 3 months, 6 months, a year, or on a permanent basis, certain functions. When there's this segregation of duties and there's somebody who's apart from let's say the direct chain of command, it tends to be found out more quickly. Just like you might have internal audit, you might have external auditors. They come in and they're looking to make sure that everything's accurate, or they have to understand the process. They see what is going on. If something's doesn't smell right, doesn't look right, isn't right, they have an easier way of identifying and escalating whatever the situation happens to be or whatever the problem is to get that found out. So, so having a separate set of eyes, a fresh set of eyes, a different set of eyes supports the segregation of duties.
Yeah, that's interesting, getting a fresh set of eyes on things. One of the things we offer here at Strategic Treasurer is staff augmentation. So if you're drowning in the daily workload demands of corporate finance, or if you feel stretched thin and you're unable to focus on strategic initiatives, leave the day-to-day operational tasks to Strategic Treasurer. Our experts will seamlessly integrate into your existing team, working alongside you to optimize cash management and enhance risk management strategies. We'll bring fresh insights and innovative solutions to your treasury operations. We'll negotiate favorable terms and maximize your liquidity and investment opportunities. Augment your staff with Strategic Treasurer and gain a powerhouse of knowledge and skills without the hassle and cost of recruiting and training additional staff. Get in touch today and experience the power of staff augmentation. You can learn more by visiting strategictreasurer.com. You have any final thoughts, Greg?
Yeah, appreciate the little commercial in there. Well, a couple of things, John, at the end. This scheme collapsed in 2008. It was exacerbated by the financial crisis that triggered withdrawals, and that allowed people to say, hey, I can't get all my money out. That's a problem. It also showed a number of regulatory and governance failures, and this had a pretty big impact on customer confidence because of the size and the fact that these things have been investigated for so long, and the idea that $14 billion had been recovered. But a couple other things at the end. This idea of there's a black box of secret trading, and people would look at it and say, this can't, even going from what they've said, you can't achieve these yields when you backward test it and you make the best choices that could exist. I already mentioned something about secrecy versus the principle of least privilege. There's an idea of I want to hide and keep things hidden versus, hey, there's privacy and there's a principle of least privilege. There's a significant difference between those two. And it became pretty clear that this is what was being done, especially with things like you need to send everything with your personal email. We need to do personal emails to pass data and trade information around. Don't use your work email for that. This fake confirmation and valuation from an accounting standpoint, from those who are reviewing the records, and from a banking standpoint, all of those items are, when you have good visibility, there's the ability to confirm and validate these things apart from the person who's saying, we have this much money, or this is the activity, this is the return. That independent valuation and validation is vital. So visibility is crucial.
You've reached the end of another episode of the Treasury Update podcast. Be sure to follow Strategic Treasurer on LinkedIn. Just search for Strategic Treasurer. This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.